Hello, ladies and gentlemen. Welcome back to the Harvesting Income channel. This is where you learn how to make your income and grow your income. So recently, we have seen a lot of funds which are the asset allocation funds, the likes of XEQT, VEQT, ZEQT, and there are a lot of them like ZGRO, XGRO, and XBAL, and so on. These funds basically have a wide range of exposure to markets across the world. So, for example, let's take the example of XEQT. We are going to discuss that today. So, just wanted to give you a brief idea how this works. This fund basically invests in various different ETFs across different markets. For example, they invest in the Canadian market, Canadian index, that is the Canadian portion of the whole ETF, and they also have the US portion, and they also invest in the indices in Europe and sometimes in the emerging markets. Plus, they hold some cash and a few other stocks as well. So basically, what they are trying to do is they are trying to hold um, indices across different markets so that they can provide global equity exposure to the investor. So the investor is getting exposure to US, Canada, Europe, Asia, emerging markets, all in one package. So it's basically an all-in-one solution given to the investor in a package format. And this ETF will get automatically balanced or rebalanced by the fund manager. Like they would balance the fund depending on where the good returns are coming up from, and depending on the risk, depending on the market trends, and so on. So that's the summary of the fund, but there are a lot of mechanics, there is a lot of details that we need to discuss, and this video is going to be about that. I hope you will enjoy it. Okay, to give you a quick background, this is the iShares Core Equity ETF, XEQT, and the fund was launched back in August 2019. It's a very large fund, like 19.8 billion approximately in assets, and this provides the one ticket solution, just like I explained before, by providing exposure to North America, US, Canada, Europe, emerging markets, etc. There are different ETFs for different geographies or different regions. So basically, the fund aims for overall capital growth, and the fund will provide some distributions of the dividends, but it's not a pure income or dividend oriented fund, and it's more like an index fund, I would say. Of course, there is a component of growth, but it's more like a regular plain vanilla index fund. But you have indices spread across different geographies, different regions, different markets. So that's providing you a diversification globally. So even if the US markets were to, fall, then you have other markets which probably are doing okay or doing well. So that way you're able to, diversify your risk. So that's the summary of the fund. And before we go ahead, this is a quick disclaimer that I'm not a financial advisor. So you need to do your own due diligence, and also whatever is being discussed is purely for education purpose. So with that out of the way, let's look at the other details of the fund, especially the performance. So if you look at the performance, it's been pretty good. Last year, the markets have been good. So that's why you see a price return of 25.8%. Distributions are modest, 1.6%, because this behaves almost like a typical index ETF, just like your SPY or Spider, or even IVV or VOO from Vanguard. So if you're familiar with those names, this more or less functions like that. But the thing is, like, you are not focusing on just one market, you are buying across different markets, so that way it is a little diversified. So this is the performance over the last 12 months, and this can vary also, so just bear that in mind. So that is just to give you the crux of this fund, and I can show you the holdings here, but I'll also open the website and show you this information. According to the information that we have on the screen, the holdings basically are XTOT, XIC, XEF, ITOT, XEC, and so on. Like, you can see that the first one, I will increase the size of the font here. Okay, I hope you can see this clearly now. You can see the tickers and names on the left, first two columns on the left. So yeah, you can see the major one is the XTOT, iShares Core S&P Total, which is 28.4%. XIC, which is 24.87%. XIC is for the S&P Toronto Stock Exchange, which is the Canadian market. The first one was the total US market. So US, Canada are the first two holdings. The third one is XEF, which is the MSCI EAFE that this covers Europe and Australia and a few other markets. It comes up to about 24.37%. So these are the major ones, and ITOT is exactly similar to the XTOT, like it's a little slight variant, but this also covers the US market, 17% roughly. So the first one and the fourth one are kind of related, same market, US market. So these are the major holdings. We also have some XEC, which is the emerging market portion, which is roughly around 5%. And then you have a small portion of Canadian dollars and US dollars in cash. So that's the crux of the portfolio. Just a few observations that I want to share, which I have given below. The first and the fourth one, XTOT and IoT, like I mentioned, they are covering the US market, which is over 45%. Like so, more than 45% is in the US market. But still, it's good enough because you are trying to use that as the core and then diversify into other secondary markets and other satellite markets. So that's how this fund is constructed. Like imagine that this itself is the whole portfolio. So your 45% is the US portion of your total portfolio, and then you have like a 24% in Europe and Australia and all that, plus another 5% emerging markets, plus some cash. So that's how this portfolio has been constructed, assuming this is the total portfolio. So two ways of looking at it. Either this could be a core part of your portfolio or the entire portfolio itself, or you could be using it as a component in your whole investing strategy. Okay. Yeah, the other parts have been explained already. XIC is on the Canadian market. XEF is Europe, Asian, and Australian markets. XEC is the emerging market. So this is what we have here. If I show you on the website, you have the same information here of all these companies. And if I look at the underlying holdings, like if I look at the underlying holdings, you will be familiar with most of them are from the S&P 500. Like a few exceptions would be there. You have Nvidia, you have Apple. Royal Bank of Canada is from the Canadian market. It's from the Toronto Stock Exchange listed. And Microsoft, Amazon, Toronto Dominion. Again, this is Canadian. So as you go on, you will find a mix of US, Canadian companies, and occasionally you might find something not listed in North America. You might find other companies, but it's fairly diversified across the world. That's the whole concept here. Okay, going back to the slide, let's look at the pros and cons. Like, so you are using one ticket solution to access US, Canada, Europe, and other parts of Asia plus emerging markets in one piece, one solution. So that's the convenience that you have. That's one major pro. The second part is the portfolio takes care of the asset allocation between different countries or different regions or markets. So basically, you passively invest in one fund. The fund manager or the fund takes care of balancing it, rebalancing it, and automatically adjusting it. So that's the advantage that you have, saving you time and saving you efforts. And third point is also on the efficiency front. It is a low cost ETF. Like it is 18 basis point, 0.18, which is one of the lowest in the category, and total expense ratio is 0.20, again, which is very reasonable. And this fund is listed in Toronto Stock Exchange and available in Canadian currency. So this is a great option for Canadian investors who are looking for a global all-in-one solution in one ticket ETF format. So you have 5 broad holdings and multiple funds within the same fund. So it's all in one solution. Like it makes your life easier. So those were the positive points or the pros. But I have to give you the other side drawbacks also to give you a balanced view on this. And some of you watching this may be wondering, is it really meant for me? So this is not meant for active or moderately active investors. Uh, some of you who are pretty active, like you know how to manage this rebalancing, and you want to have the flexibility to allocate to certain countries or certain regions. So in that case, you may not find use in this fund. And this is also not suitable for moderately active investors who can manage it themselves. Like that's another point. And the second part of it is like for someone who is looking at a pure growth strategy, like you want high growth and high growth companies and high returns, then this strategy is not for you. Similarly, if you are someone looking for a high amount of cash flow or yield, you want regular distributions which are very, higher yield category, like in some covered call funds. This fund is not for that income seekers. Neither is it for growth seekers. So if you are a pure income investor or a pure growth oriented investor, then this may not work for you. Of course, there is a certain amount of growth, but this is more like an index or a passive growth investor product. So this is not suited for typical growth or income investors. And again, the third point is like some investors would be more focused on the domestic market, like they are not going to diversify internationally, or probably they find some multinational companies within their country, like US investors already have international exposure within the Nasdaq or the S&P 500, and they are not keen on putting money in some other country's index and all that. So if that is your mindset, or if that is what you're thinking, then probably it's not suited for you. And if you are happy with domestic market investment, then this is not for you, and you can continue with your strategy. It's perfectly fine. Not to say that this fund is not good at all, like, but this is not meant for these types of investor profiles. There are some cons above which can be mitigated. For example, a growth or income seeking investors can use this along with their other funds which meet their growth or income goals and combine it with this fund as well. So if you want to add a safety or a kind of passive index also to your portfolio to get that automated rebalancing and safety, then you can look at this. So that's my suggestion. And again, this is very individualistic, and you have to consult with your financial advisor for specific recommendations. Now, before we go to the end, like this is my final thoughts. We have covered most of the points that we discussed, and my final thought is this ETF is mostly a good pick for typical couch potatoes or typical passive investors, right? Who want a set it and forget it solutions. I want to just buy this ETF, buy 100 quantity of this XEQT, and then I'll just let it grow and let it perform its magic. So if you are that type of person, then XEQT would be a good solution for you. However, the point to note is this is for long term. So if you want to do a set it and forget it solution, you have to be a long term investor. You have to hold it for the long term. You are not going to get a quick return in a couple of months or 3 months. Then this is not for you. Set it and forget it is only for a long term investor. So this also suits other types of investors who want a slice of a passive index as well. Like, so they have probably multiple stocks or multiple ETFs. Now they want a simple index solution instead of that complex other solutions that they already have. They want to complement that with a simpler one. Probably this could be a good solution. And the third point says the same thing. This could complement other funds. Like you are a growth investor, but you also want some passive index exposure, or you are an income investor, you want a index growth option. So that's another option that you can look at. This is not ideal for a pure growth or someone seeking income. That's what we discussed previously. This is a great option for beginners or starters with limited knowledge. Let's say you are coming into the markets for the first time. Just a couple of days ago or last week, you opened your brokerage account, and you don't know where to start, like what to buy, which is high, which is low, when to buy, when to sell. Or you want something like you want to buy it and just let it stay there. You don't want to check the prices every day. So in that case, this can be a great foundation to start with. You can buy this assuming that you are going to hold for long term. If you're going to, meddle with it, or try to, buy a little bit and sell a little bit here and there in a few days or a few weeks, then this is not for you. But for beginners who don't have any idea, go for the set it for the long term and focus on the wealth creation and wealth building process. And then this could be a great solution to start with. So with that thought, I would say that it has been a great pleasure to bring these new funds in addition to the typical covered call funds that we discussed. So even if you are an income oriented investor, you can look at the passive index funds as an option to have returns which are equal to the market or matching with the market returns. So I hope you like this video. If you have any comments or questions, please drop them in the in the comment section below. And don't forget to subscribe to the channel if you find it useful. Have a great day. Happy investing.